Welcome back to the deep dive. Today, we are cracking open the Q2 FY2026 earnings call for, well, the biggest name in the global egg industry.
And if you think eggs are just a boring commodity, you really need to stick around for this one.
We do, because this was a fascinating quarter. It really felt like a battlefield. You have the old commodity cycle on one side and this aggressive new company strategy on the other.
That's it, exactly.
Yeah.
This is a company trying to fundamentally change its own DNA, and you, the listener, get a front row seat to see if it's working.
So that's our mission today. We're going to figure out how this historically boom and bust business is trying to engineer itself into something much more stable, a resilient growth company.
Yeah, moving away from just the daily price of white eggs and toward, real diversified value-add products.
Okay, let's get into it with the results snapshot, because right off the bat, the headline was confusing. A classic mixed print.
An EPS beat, but a revenue miss.
Exactly. The company delivered GAAP diluted earnings per share of $2.13, and that comfortably beat the consensus estimate of $1.95.
Right. A solid 9% beat on the bottom line. So you hear that and think, okay, great news.
But there's always a but.
A huge but. You have to put that number in context. I mean, that $2.13 in earnings, it's down a staggering 52% from the $4.47 they posted in the same quarter last year.
52%. So the beat just means they're managing the downturn well, but they are absolutely in a downturn.
Without a doubt. And the revenue side of the story, it doesn't really soften that blow.
No, it doesn't. Net revenue was $769.5 million, which missed the street's estimate of about $797 million. And just like earnings, the year-over-year drop was huge, down 19%.
And that compression, that sharp drop, that's the whole story right there. It shows you just how fast and how hard egg prices, which drove insane profits in 2025, have crashed back down to earth.
So given this contradiction, the beat on one hand, the massive drop on the other, how did the market react?
Well, it was a roller coaster in miniature. Right after the announcement, pre-market, the stock actually popped. It was up over 3.5%.
Fueled by that EPS beat, I imagine.
Absolutely.
Yeah.
But that feeling did not last. As soon as people started digging in and looking at this year-over-year numbers, the whole sentiment just flipped.
And the stock ended up down for the day.
Yeah, it traded down over 3%. So the market basically said, nice cost control, but the commodity cycle still rules here.
Okay, so this is where it gets really interesting. Let's do the deep dive into their strategy. Because management spent the entire call trying to convince everyone that this result actually proved their strategy is working.
Right. They're saying, look, prices collapsed and we were still this profitable. That's the resilience we've been building.
And they have the financial firepower to back that story up. I mean, they generated over $100 million in net income.
And almost $95 million in cash flow from operations. But the real number, the one that just jumps off the page, is on the balance sheet.
The cash pile.
The cash pile. They ended the quarter with basically zero debt, sitting on $1.1 billion in cash and temporary investments.
$1.1 billion. That's astounding. But I have to ask, does that much cash sitting there mean they're not moving fast enough on M&A? Is that optionality or is it just inaction?
That is the perfect question. And management's answer was basically, this is strategic optionality. They kept hammering this one quote, that their goal is building strong base returns and multiple growth engines.
So in a downturn, that cash isn't just sitting there, it's a weapon.
It's a huge weapon. It means they can acquire competitors who are struggling. They can invest without taking on debt. It lets them be the consolidator.
Which you can see happening in their portfolio mix shift. I mean, this is really the heart of their whole diversification story.
It is. Let's break this down for everyone because the numbers are they're so important. We're tracking two big movements here.
Okay, what's the first one?
The first is just the shrinking importance of their legacy business. So regular shell eggs, they're still the majority of sales, about 84%, but that's down from almost 95% just 1 year ago.
That is a massive shift in just 12 months.
It's diversification on hyperspeed. And the second movement is even more important. It's what's happening inside that shell egg business.
You're talking about specialty eggs, the cage-free, the organic.
Exactly. Specialty eggs now make up 44% of all their shell egg sales. Last year, the number was just under 32%.
Wow. So they've gone from about a third to nearly half in a single year. That's where the margin stability comes from.
And then you look at the really crucial metric. You combine those specialty eggs with their prepared food segment.
The high-growth stuff.
The high-growth stuff. And together, That's now 46.4% of total net sales. They went from 31% a year ago to over 46% now.
They are so close to that tipping point, that 50% mark, where value add is actually the majority of their business.
And when that happens, it fundamentally changes everything. It changes their relationship with retailers. It changes their margin profile. It's the whole game.
Okay, so that brings us perfectly to the real growth engine here, which is prepared foods. This is where they're putting the serious money to work.
Oh, absolutely. Prepared food sales were about $72 million. That's an increase of, get this, 586% year over year.
586%. Okay, some of that's from acquisitions, but still, the direction is crystal clear.
And management guided that they're driving this segment toward a 9 to 10% compound annual growth rate. That is a huge long-term goal.
And they're backing it up with serious CapEx. We heard about a new high-speed pancake line. What was it, a $15 million investment?
Almost 15 million, yeah. And that's going to add about 12 million pounds of capacity. And then there's another $15 million project to consolidate scramble egg production. That one adds another 17 million pounds of capacity.
So they're spending big to build out this higher margin business.
But, and this is a really important, but that kind of rapid expansion comes at a cost. Management was very clear about this.
It's like they're trying to renovate the entire kitchen while still running a busy restaurant.
Yeah. That is the perfect analogy. They warned everyone that this work is going to mean temporary lower volumes and higher costs for the rest of this fiscal year.
So Q3 could be ugly for this segment.
They basically said as much. They expect Q3 to show a pullback in prepared foods performance. Now, they're sticking to their long-term goal of a 19% EBITDA margin for this business.
Which is an ambitious target.
Very ambitious. But they're saying you have to look past the next couple of quarters of, construction dust to see the prize at the end.
Okay, so we've got the strategy, the investment, and the cash to fund it. Let's connect this all back to the macro picture. What's driving all the stocks' volatility?
It always comes back to the egg price cycle. I mean, we saw prices normalize so fast from the 2025 peak. BLS data showed the average price fell from over $6 in March down to $2.86 by November?
That's a collapse. And it really underlines why they're pushing so hard on these new hybrid pricing models with their customers.
It's a defense mechanism. It has to be. I mean, the national loose egg benchmark was recently cited at just 58 cents a dozen. 58 cents.
Wow.
An old school producer on a pure commodity contract would be bleeding cash at that price.
Yeah.
These new contracts insulate them from that kind of catastrophic downside.
But there's one shadow that hangs over this whole industry that you can't build a contract to avoid, and that's HPAI. Avian flu.
Yeah. And management was so direct about this, they said HPAI supply challenges are, quote, not behind us. The current epicurve looks a lot like previous outbreaks, including the really bad one in 2022.
The USDA said the industry lost something like 42 million hens in 2025 alone.
It's a terrifying number, and it's a structural risk. But for this company, it's also weirdly a competitive advantage.
How so?
Because when HPAI hits, it wipes out supply and puts smaller, debt-heavy producers under incredible stress. But our company, with its $1.1 billion in cash, can maintain its operations, keep supplying its customers, and then potentially
scoop up the assets of those struggling competitors.
Exactly. It turns a macro crisis into a tool for market consolidation.
And while all this is happening, they're still returning cash to shareholders. They bought back almost $75 million in stock this quarter.
And they paid out their variable dividend, about 72 cents a share, which is right in line with their policy of returning a third of net income. They are firing on all cylinders: growth, M&A, and shareholder returns.
We even saw a small acquisition get done, right? Clean Egg LLC.
Yeah, a small, smart, timely deal to expand their cage-free and free-range capacity. It feeds directly into that specialty mix number we were talking about. Management said the M&A pipeline is full, and they're looking for things that add to that stability story.
All right, that brings us to our favorite segment. This is not financial advice. We take everything we've just unpacked and pitch an outrageous but plausible trade idea.
And the idea here is built on a core conflict. The market is pricing this stock like a dumb commodity play, right? It's just focused on the ugly year-over-year numbers.
But the fundamentals are screaming that a huge structural change is happening under the surface.
Exactly. The market is mispricing the temporary pain of this CapEx transition against the very real recurring risk of a major HPAI outbreak.
So how do you play both sides of that? The near-term pain and the long-term potential gain?
Okay, here's the pitch. It's a kind of leverage collar strategy.
Right.
First, you sell or short the stock right now targeting a drop into the mid-$70.
You're betting on the bad news that management basically guaranteed is coming.
You're betting on the renovation dust. The lower volumes and higher costs from this big expansion are going to drag on earnings, especially in Q3, and that should push the stock down.
Okay, so that's the short-term bearish side. But what about the massive upside if HPI hits or if the strategy works even faster than expected?
That's the second half of the trade. At the same time, you buy far out-of-the-money call options that expire 12 to 18 months from now. This is your lottery ticket, and it pays off on two potential catalysts.
What are they?
Catalyst number one, HPAI comes roaring back. It creates a massive supply shock. Conventional egg prices spike, and the stock soars with it because it still has that commodity correlation.
Okay. And catalyst number two.
The new capacity comes online ahead of schedule. The numbers look great, and management declares that the 50% plus specialty mix is here to stay. That could trigger a huge re-rating of the stock where the market finally starts treating it like a stable consumer staple, not a volatile commodity producer.
And that $1.1 billion cash pile is the ultimate safety net for this whole idea.
It's the floor. It minimizes any real bankruptcy risk while they're going through this transition, and it keeps the door open for a huge game-changing acquisition that could be its own catalyst. It's a trade that acknowledges the short-term weakness while betting big on the long-term story winning out.
So to wrap this all up for you, the Q2 print was a battle. On one side, the raw power of the commodity cycle, which you saw in that earnings collapse. On the other, a massive strategic pivot, which you can see in that 46% mix shift and the huge investments in prepared foods.
This company has been through these down cycles before, and they've always come out stronger. So the real question for you, the investor, is this. Is their strategy finally strong enough to break the cycle? Can they really get specialty over 50% and hit that 19% margin target? Or, at the end of the day, does the commodity market still call all the shots?
A fascinating tension, and one we'll be watching very closely. Thanks for joining us for this deep dive. We'll see you next time.